did you? Anything you want.
Banks now ready to unleash a historic short squeeze in the gold market. Bullion banks are now in one of the most bullish trading positions in the gold market in the past decade, as they have already tightened the noose around hedge funds and speculators that are massively short the gold market. Now they are preparing to unleash a historic short squeeze. Bullion banks even more bullish on gold. Commercials have covered more short positions in the gold market. They are now on the cusp of being net long the gold market for the first time in over a decade. Below you can see the commercials approaching a net long position, even without the data from this week's action being reflected yet. See chart below. Continued commercial short covering in gold. It will be very interesting to see next week's report. Long-term chart shows bullion banks turning bullish. Gold bullion banks and commercial hedgers continue to take the other side of the trade, from hedge funds and small speculators, as they approach being long the gold market for one of the few times in the past 24 years. See chart below. 24 years chart of commercial positioning in gold. Silver. Commercials also continued to cover shorts positions in the silver market. Here is a look at the past decade of commercial short positions in the silver market. See chart below. More commercial short covering in silver. Here is a long-term look at commercial short positions in the silver market. See chart below. 24 years chart of commercial positioning in silver. Stay disciplined. We have already witnessed large-scale capitulation in the gold and silver markets, both in the precious metals and the underlying shares of the high-quality companies that mine and explore for the metals. We may have already seen the bottom of the gold market when it hit $1,160 in overnight trading in Japan during the final stages of last week's brutal takedown. So $1,160 will be the key number to watch in the short term. For those who are taking advantage of this historic capitulation, the odds greatly favor a major upside reversal, which we believe is already underway. Here is how central banks will end up hodling Bitcoin, BTC, like they hold gold. Many central banks across the globe hold gold. As a matter of fact, most of the gold is locked up in government vaults all around the world. These governments hold gold as one of their reserve assets to hedge against periods of market unrest and for periods when they need to liquidate their assets quickly. Nothing moves faster in the markets than gold. But its liquidity is being threatened by another form of gold that is known as Bitcoin, BTC. Yes. Bitcoin has often been referred to as the digital gold of the 21st century. Reason being that it is in constant demand and it embraces the most revolutionary technologies of cryptography and blockchain technology. One can claim that it is all hype and mania, but the current Bitcoin rush can be compared to the gold rush that led many Americans to look west to California in the 1800s. The current price predictions of BTC are as high as $500,000 by 2024. So, could central banks end up hodling Bitcoin, BTC, as part of their national reserves? On an honest note, it would not be a surprise if we found some of the prominent governments holding some of their assets in Bitcoin. Sure, they would not admit it. But any shrewd investor who sees the potential in BTC would want to grab some before its price goes up to the moon. This is primarily due to the fact that we already know that the amount of BTC to be minted is 21 million. This means it is finite. Over 80% of the total of 21 million BTC in Satoshi's white paper has already been mined. Utilizing the common economics theory of supply and demand, as BTC becomes more popular, so will its price. Therefore, individuals and governments will be looking to stockpile the digital asset. The last BTC is calculated as being mined in 2145, so there is a lot of time for its price to continue to skyrocket. BTC is indeed digital gold. Similar sentiments of BTC replacing gold have been expressed by billionaire investor Bill Miller, who was quoted as saying, "If it becomes much more valuable, it's then likely that various central banks begin to think of it as another potential asset just like they hold gold. That would open up the market extremely significantly." Miller, who has put in about 1% of his liquid net worth on Bitcoin, thinks of the digital asset as a non-correlated asset that can be compared to gold. He noted that BTC is easily more transportable than gold and can actually be used to buy things. This observation by Miller adds to the earlier mentioned liquidity that central banks look for in an asset. BTC can be easily sold by central banks on any of the numerous exchanges during times of need. In conclusion, the value of BTC will most definitely go up, since we all know that it is finite at 21 million BTC to be minted. With its value going up and liquidity being as simple as typing in a BTC address and sending, more and more central banks will consider the digital assets as part of its reserve assets. More big banks turn bullish on gold prices and mining stocks. Bank of Montreal says gold prices worth a look. The case for holding gold continues to get stronger. Mark these words, we may not see $1,300 gold prices in the next few months and quarters. The precious metal could be priced much higher. The big investment houses are turning bullish on gold. This could bring a lot of buyers to the market. It's a great news for gold bugs, too. Just recently, Bank of Montreal, NYSE BMO, a major Canadian bank, issued a report in favor of gold prices and gold mining companies. In the report, BMO analysts said, macroeconomic, company fundamentals and valuation all point toward an opportunity for investors to benefit from increased exposure to precious metal equities. The analysts added, we expect geopolitical risk and growing concerns of surrounding the U.S. economy to keep macro asset allocators interested in gold. This still leaves a potential sweet spot where macro and micro are for once aligned on the positive side for gold. Also, guess what? Bank of Montreal expects higher gold prices $1,327/ounce for 2018, which is 4% higher than what the bank had previously said. Leading German bank calls for higher gold prices. Mind you, Bank of Montreal isn't the only major bank saying that gold prices could move higher. Commerzbank AG, a leading German bank, said in its gold prices outlook for 2018, the gold price is likely next year to continue the rise it commenced 2 years ago. Commerzbank expected the precious metal to trade at an average price of $1,300 in the first 2 quarters of 2018. And around $1,350 in the last 2 quarters. Here's the thing, the list of banks saying positive things about gold is getting bigger. If a bank is not bullish on the metal, they aren't bearish either. Why do banks matter? First of all, these banks manage a lot of money by themselves. So, if they are bullish on gold, they could increase their exposure to the metal for their own portfolios, and they may persuade their clients to do so as well. Know this, major institutional buyers follow the big banks. If you recall, in 2013, big banks turned pessimistic on gold. Big investors followed their advice and ran for the exits. So, if we assume that institutional buyers will do the same as the large banks, they could buy a lot of gold. Finally, big banks turning optimistic entices new investors. This could bring new buyers to the gold market that didn't even consider investing in gold before. Gold prices outlook for 2018 and beyond. Dear reader, Big banks becoming bullish on the yellow precious metal isn't a big surprise. Long-term readers of Lombardi Letter can attest that I have been predicting this for a while now. Big banks forecasting higher gold prices is certainly a good thing. They have a lot of influence in the markets. For the rest of 2018 and beyond, I remain bullish on gold. I continue to take the stance that gold could reach toward $2,000 much faster than currently expected. We could see this happen in matter of a few years. And, as gold prices soar, gold mining stocks could become the next millionaire maker investments. World Bank thinks gold and silver have seen their best days in 2018. The gold market may have put in its best performance of the year as the first quarter came to an end, and investors looking for higher silver prices might be disappointed this year, according to the latest report from the World Bank. In its semi-annual report, released last month, the International Bank for Banks said its precious metals price index saw a 4% increase in the first quarter, following marginal growth in the first quarter of 2017. The gains in the first 3 months of the year were due to a 4% rally in gold and a 6% rally in platinum prices. The analysts noted that the two metals were pushed higher because of expectations of rising inflation, growing geopolitical tensions, and a weaker US dollar. Silver prices were only slightly higher in the first quarter of 2018, compared to its gains during the same period last year. Silver prices edged higher on declining mine production and despite relatively weak investment demand compared to the other two metals, the World Bank said. Looking ahead, the analysts said that they expect silver prices to struggle through the rest of the year. The comments come as silver price remained trapped in a narrow trading range. July silver futures last traded at $16.59 an ounce, down 2.6% since the start of the year. Silver prices are forecast to ease slightly on moderating industrial demand, the report said. More than half of silver consumption goes to industrial use. Demand from the photovoltaic and electronic sectors remains strong, but is being eroded by substitution and more efficient production techniques that use less silver. Turning to gold, the World Bank said that it is only forecasting a 3% gain for the yellow metal in 2018, which indicates the market doesn't have much upside from current prices. Gold prices also remain stuck in the middle of its trading range. June gold futures last traded at $1,319.10 an ounce, up 1% since the start of the year. Upside risks to the forecast include deepening geopolitical tensions, delays in central bank rate increases, and a weaker than expected dollar. Downside risks include stronger economic growth, rising equity markets, a stronger dollar, and an easing in geopolitical tensions, the analyst said.